I'd like to reflect on 5 key insights from 2022. As we reflect on a rather momentous year, I would like to share these 5 insights from 2022 that I believe will continue to influence financial markets in this new year. First, valuation matters. After starting the year at elevated levels, equity valuations quickly adjusted downward once investors realized that steep interest rate hikes were imminent. While equity markets sold off meaningfully during 2022, actual earnings only fell modestly. In fact, the S&P 500 index ended the year just below the average level for the last 25 years. Earnings growth for 2023 is projected to slow, so we're watchful for valuations in our portfolios. 2, the Fed remains committed to fighting inflation. Market expectations for federal funds rates were consistently too low in 22. In fact, how high the Federal Reserve will raise rates and how long they will hold them at these elevated levels remains unknown. What is clear is that they're determined to avoid a replay of the 1970s and will do whatever it takes to get inflation under control and back to healthier levels. Even if their actions push the US economy into a recession. In 2023, the Fed's primary focus will be on lowering wage inflation, and we should not expect a shift in policy unless the labor market also weakens considerably. Large companies are already reporting layoffs, so this is happening as we speak. Third matter is China has changed. The year 2022 proved to be one of considerable change in China, which saw the leadership of President Xi Jinping extended. Notably, the Chinese government has indicated that economic growth remains important, while it intends to reinvigorate socially oriented goals as well. This could lead to less predictable economic policy decisions into their future. We saw the easing of COVID restrictions in December, and investors should be prepared for more uncertainty going forward as we try to work out the supply chain issues. 4, stocks and bonds can sell off simultaneously. Bonds have historically offered ballast to investors' portfolios when the equities have faltered. However, this has not always been the case, particularly in periods when the Fed embarks on a new hiking cycle, as happened in 2022. Further, 2022 was somewhat of an outlier because the Fed usually tightens when growth is accelerating, and that was not the case in 2022. Interest rate hikes were typically more gradual, but we saw rather steep progress last year. Fortunately, stock and bond correlation should likely fall in 2023 as the Fed appears close to the end of its hiking cycle. Ending on good news, yield is back. The silver lining to the rout in bonds during 2022 is that bonds have healthy yields once again. This means investors will no longer have to take significant credit risk to get a healthy yield from their bond portfolio. In addition, investors can also enjoy potentially larger income buffer to help offset any further increases in interest rates. As we welcome 2023, we will continue to monitor these market themes and provide updates accordingly. Now, let's move toward our goals this year while creating lasting memories with family and friends. Please reach out to me with any questions. Thank you.